You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tussaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. Welcome back to everyone's favorite bi-weekly source. I hope it's your favorite. If you're listening and it's not your favorite, well, then maybe we'll win you over. And hopefully, if you are listening, though, it is your favorite bi-weekly source for all things options related. A little bit of wit, a little bit of wisdom, a little bit of education, throw in a smattering of unusual activity, some strategery, some listener mail, and you stir it all up in the heady brew that is the option block. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few programs for you guys to check out on said network, including 500-plus archived episodes of this fine program, The Option Block, the best place to find all of that great content. Of course, the mothership, the flagship, theoptionsinsider.com. While you're there, click on the Insider Radio Network tab, top left corner of the homepage, and your audio journey has begun. I should also mention there's that call out on the right-hand side, too. So you don't even have to do that. If you can't be troubled to lift the finger to do 2 clicks, you can do 1. Just choose the show you like on the call out, and you're good to go. Of course, you can also find it iTunes, TuneIn, Stitcher, pretty much wherever you find your favorite podcast programs. Of course, also via our mobile app, available for iOS, Android, and indeed the Fire OS, and a growing number of you, of course, tuning in via Mixlr Live, MIXLR. So grab that app or check us out on Twitter and hop on that link when we tweet it out, and you guys can go out there and stream the program live. MIXLR. You have to have an account to chat with us there, but if you want to still hit us up via the usual outlets, social media and things, if they come to us in time, we can usually still answer them on the program. Even if you don't have an account, can't chat. And speaking of chatting, I've been chatting here a little bit earlier before the old program with the Greasy Meatball himself, Mr. Mark Sebastian. He deigned to appear with us in person here, live in the old studio. Mr. Greasy Meatball, how are things going in the land of the pit, sir?
It's a beautiful day in the land of the pit, beautiful day in Chicago. And I'll tell you, it's a beautiful day at the Options Insider Radio offices. Quite the setup here, Mark. It's always a pleasure to be joined by yourself and your doppelganger, Commander Riker.
Of course, we do still have our scenic St. Charles tourism book from the last big live show.
Let me figure out where I'm going next.
I know you're heading on the trains after this. Maybe a stop at St. Charles is warranted. And speaking of stopping over at St. Charles, we are also joined by someone who doesn't have to stop because he's already there. Uncle Mike Tussaw from RCM Wealth Advisors. Uncle Mike, welcome back to the old program, sir.
You know what? Ever since all the St. Charles publicity that we've been giving lately, I am getting more people. I never realized there were this many option traders in St. Charles. So all my St. Charles option trading brethren, look me up. We need to form a more tight alliance.
There you go. St. Charles options traders unite. Meanwhile, we're going to unite for the first segment, the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody. Welcome to the Trading Block. This is indeed the portion of the program where we break down what was moving, what was shaking, what was rocking, what was rolling on the old street today. And it was a bit of an interesting day, a little bit of vacillation, kind of depending on where you were looking. The narrative was a little bit different. The day ended slightly in the red. Most of the major indices off about, S&P off nearly 1/4 percentage point or so. The Nasdaq and the Dow off similar percentages. VIX cash having a slight inhale up fractionally on the day, right around the 18.5 level or so. But that kind of belies what was going on out there on the old streets, all this activity. Mark, you and I were talking before the program began. A lot of indicators we like to watch, like VVIX starting to creep back into that red territory again, hovering north of 95 today after getting back into the 70 handle not that long ago. So seems like there's some volatility in the horizon. Would you concur there, sir? Yeah,
I mean, the VVIX by itself has been pretty apparent that there's some real fears about what's going on. The market action, I think a year ago on the ECB action, how much would the market have rallied today? 25, 30
would have been a much different scenario.
Yeah, and now they don't even care. Just shows you that some of the confidence lost in central bankers. People just don't trust them anymore. They don't like them. Then the other piece I noticed is that we continue to see oil vol backing up a little bit, and oil seeming to calm down, which is maybe part of the reason why VIX has made this move back below 20. But, a lot of I'm starting to see an end to the short squeeze that hit a lot of these inexpensive oil names. So there's some really interesting things pushing around the market today. Biggest Dollar General was up $8 today, Mark. I don't know if you saw that.
I know Uncle Mike saw it. That is
he did.
His favorite name. Uncle Mike, you been watching the Dollar General today?
We're shopping at the one in beautiful St. Charles, Illinois.
I don't know if we actually have one of those.
I don't know that you do either.
Yeah.
But you know what you do have? You have Baltria, a classic exotic automobiles from the last 100 years. Car collection is open to the public for complimentary viewing. Also provides brokering, consignment sales, and mechanical evaluation for all cars.
There you go. He's reading your brochure as we talk, Uncle Mike. So he's learning about the paradise on earth that is St. Charles, Illinois. But you're right. Good old Dollar General. Of course, we always mock Uncle Mike, perhaps unfairly, for his love for all things dollar store. I'm not sure. Are you more of a dollar store guy, as I recall, than Dollar General, correct?
I like them both. Anything where you can go and buy your kids toys that keep them happy for about 4 hours and you're out the door for $8.95. I like places like that.
That's true. The little kid factor of the dollar store is through the roof. You can go there and they can come out with their arms loaded and just huge smile on their face, and it costs you like $4. It's fantastic.
And you know what? Who cares about lead paint? That's all over.
As long as they don't eat it.
As long as they don't eat it. You just have to be, no matter what you do, play with it all you want. Don't put it in your mouth.
The kids have attention span about an hour anyway, so they're going to play with it and throw it away. So you get your $4 worth, and then they're on to the next thing. And as long as they didn't eat it, I think you're good. But yeah, Dollar General up and over 10% today, 10.5%. They had earnings before the open. So here we are saying earnings season kind of tailing off. You had a few surprises lurking out there in the weeds. This name's been doing about 3,400 contracts a day of late, doing over 15,000 today. No surprise. The lion's share of that coming on the call side with the stock up, like I said, 10%, nearly 8 handles today. So quite the rally in the land. Apparently things are good in the land of selling things for $1.
So here's a question for you guys. Dollar General, great store, but really more importantly, how does this affect a name like Walmart or Target? Does 2-3 years ago, one might have said, boy, Dollar General doing great is bad for Walmart or bad for Target. We're a couple years in. Does that show, point towards strength for Walmart, or do you think that, or a Target or something along those lines, or do you think that points toward them continuing to have some problems and having their margins tightened?
I mean, I know they're kind of different, but I kind of view them as two sides of a similar coin in that, where there's strength in one, there should be strength in the other. And Walmart, of course, reported back about a few weeks ago or so now, and their numbers were pretty decent as well. They rallied, looks like about 4 or 5 handles post earnings in the subsequent sessions. So I can't envision a scenario where a Dollar General blows the doors off of it, but Walmart is somehow hurting. You think there's that cost conscious of a consumer? Will they'll spend $1?
I'm interested in that.
But not 5 or 8?
I mean, I'm interested in that. I mean, Mark, what are your thoughts? I mean, do you think that do you think that now that we've kind of hashed out where all these people land, that Dollar General doing really well is still negative for Walmart, or is it positive?
No, I think it's positive. I think a rising tide lifts all boats. People are, if they're cost conscious, which is probably why you're shopping in a Dollar General, aside from us going there to scam some cheap toys for our kids, that could be a large size of their business. We shouldn't discount that. But aside from that, people who are, if you're cost conscious, the next step up is going to be a Walmart, and I'd imagine you're going to do the lion's share of your real shopping, grocery, produce, light clothes, et cetera, at a store like that.
Well, in looking at it, I would agree with Mark in that they are two sides of a very similar coin. If we were recently, like a couple of months ago, we bought a flat screen TV, and Walmart was one of the places with which we looked. You're not going to find something like that at Dollar General. Whereas, and if you want to buy like an Xbox or an Xbox video game or something like that, that's not going to be at a Dollar General. Whereas at a Dollar General, you're going to find some weird kazoo made in some country that kind of resembles China.
I'd be scared of the flat screen TV you got at Dollar General. Yeah. That would blow up instantly.
A kazoo at Dollar General is the only person who doesn't have a kazoo from Dollar General is the person who actually made the kazoo.
Because they know what's in it.
Yeah, well, that too. The piece that was interesting is Walmart was when that thing got bashed back last October, I think all of us kind of uniformly agreed that was a little overdone and it was a steal. Since then, it's basically gotten back to its pre-October spanking levels. And it's starting to look like it was a steal for 56. Starting to look like it's really found some footing. And, you've got the 200-day still dropping a little bit, but you got the 50-day definitely moving up. I mean, it looks like there's, it's more likely to make a run at 75.80 than it is to make a run back below 60.
Yeah, particularly if this bull rally continues. Speaking of bull rallies, Mike, we got so diverted.
There's a lot of people here. Marks and Mikes.
They look identical.
It was funny when Mike said, "I agree with Mark." I was like, "Oh, nice," and then I was like, "Oh, the other Mark."
The good one, the good-looking one. But Mike, we got so down the rabbit hole of your favorite name, Dollar General. We didn't even get a chance to ask you what else caught your eye in today's activity, sir.
Well, a couple things. Just to expand a little bit on Walmart, for example, I actually got into Walmart at the beginning of this is a pretty cool collar story, actually. I got into it for some clients for not a large position, but it was a collar on it at the beginning of 2015. We got into it in the low 80s, I believe it was. Let me look here. Around that level. So got out of it. Didn't get out of it, but we ended up getting, I believe we had the 75 put on it. So now when we readjusted everything at the end of last year, this is kind of one of those fun stories to where we're short the 70 call right now. And if things go the way with which they could go, we could actually be profitable on a stock that's actually gone down from the mid 80s to the mid 60s. That's the magic of options. Doesn't always work out like that, but that was one that we did get right, so to speak, in terms of not getting our heads blown in.
Nice when hedging actually works out, isn't it, Mark?
It's
we
great.
were discussing an example of the opposite of that before the show, which will go unnamed. But nice when the hedging activity actually works out.
Yeah, that was great.
Wasn't that one of the best takeaways from RMC last week? Is what's the worst thing that could happen to a tail risk fund is a tail risk event, because then they actually have to deliver.
Right.
That was fantastic.
It was amazing. There was a couple of ththings that were really interesting. I would start off by saying, at some point we've got to get Tusa to tell a college story instead of a collar story, because the inquiring minds want to know. One of the things I was thinking about these collars and these collar stories. I don't know if you caught. One of the groups did a presentation on the uncovered covered call. And it was about the dynamic hedging of a covered call. So basically, you set up the covered call where you're long at the money, and you sell the covered call, and that gets your position long, let's say 55 deltas. And then their approach, and they found this to actually really improve returns. They found that the number one really driver of volatility in a covered call and driver of underperformance in a covered call was actually not the premium collected, and it wasn't the underlying movement in the stock price. It was timing. And so what they actually proposed was delta hedging the call at the end, delta hedging the call every night to maintain that exact same delta exposure every day. So if you sell a covered call that has, let's say, a long 70 deltas in the underlying rallies, they were actually proposing buy some stock against that covered call to maintain that 70 delta. And what they found was that vastly improved the returns on the covered call and lowered the volatility of the portfolio. So now, as I sit here and think about that, that might be a really interesting trade to do, kind of a collar with an uncovered covered call to kind of maintain that constant delta exposure executed at the collar. I think that would be a really fascinating thing to trade around. And I know that the RCM guys kind of backdoor that by doing 1x2s and different adjustment strategies. But this was just a really unique perspective to that approach.
That's very interesting on one hand, and also to me kind of rings a little bit of like an academic paper, because that's the kind of thing that sounds awesome on paper. Then I'd have to imagine, of course, you're doing it with stocks, so that's a cheaper alternative. But that's a lot of adjustments. I mean, you're talking daily delta adjustments. If you're doing like let's say you do it the right way, so you do a front month covered call because you want to get all that theta. So you're going to delta adjust that the whole way through I'd imagine it's going to leave a sizable chunk out of your returns.
I believe they were pitching this.
Yes, that's a lovely broker trade.
I believe they were pitching this more as a mutual fund type of trade or an SMA type trade. But it makes sense if I was long 10,000 shares of stock and I sold 100 calls, if I'm at that level, that would be a level where it starts looking interesting. Maybe even like a 10 lot. You could make an argument that maybe you don't do it every day, but when the delta makes a dispersion of over 100 deltas, maybe you do an adjustment.
Yeah, if you get like one extra remnant delta, you don't want to go in and try to hedge it.
No, but imagine I set up a covered call trade where I'm long 1,000 shares of stock and short the 40 delta call. Maybe what if every time the delta gets 100 deltas away from that 60 level, I did some hedging. It was really fascinating their concept. My head, I thought, well, why not just sell a VIX call over the portfolio? But the other piece that would be interesting is if you're doing this from a global perspective. So instead of doing individual covered calls, you're taking a basket of stocks. And Mike, I don't know, do you guys do this? You take a basket of stocks you think are going to do better than the S&P, and then you hedge using S&P. That would be another way to potentially do it. Yeah, you do that. So if you wanted to maintain a constant exposure against a portfolio, and then sell covered calls, it'd be an interesting thing to look at is, okay, I've got this delta exposure to the S&P, and then when my covered call gets so much, I buy shares or I sell shares. It was really fascinating what they were pointing out.
I'm guessing, you're talking to the audience at RMC, people are kind of down the options rabbit hole anyway, so there's fund managers who are using options. I'm just picturing in my head, too, your typical fund manager who's out there using covered calls, what are they doing? They're selling probably quarterly at the most. It's a set it and forget it trade. They don't want to bother with it. It's an extra bit of income. Now you're coming to them and saying, not only should you be selling at least front month, maybe weeklies to really maximize the impact of that, now you have to delta adjust.
I don't know that I would be doing weeklies, but... Well, that's why you go for, and pardon the endorsement, Mike, but that's why you go for a nuanced broker that really does have an options expertise, because they're going to look at strategies like this. And Mike's not saying, well, that's just ridiculous. That's going to take a bunch of time. That's actually, I can tell you right now, Mike's wheels are turning and he's going, that's going to be something I spend some time looking at because that might be a real value added for my clients. And that is why... I think finding brokers that have a real expertise in options is going to be such a value added, or financial consultants, financial advisors or registered investment, whatever you want to call them. Finding advisors, RCM being one of them, that have that expertise is they're going to show their teeth, they're going to grit their teeth, and that's why if and when I've been pulled aside to ask, well, who would you talk to? I go, well, I got a guy out in St. Charles you can talk to.
I don't know, all this unfettered love for Uncle Mike. Must be because you're not in the same room,
I'm a little embarrassed, but
wow.
You know, and I know he's blushing over there.
Yeah, if you could see him, he'd be blushing. All this unfettered love. But listeners, let us know what you think. A lot of you guys are streaming live right now. What your thoughts are on this uncovered covered call? I like that. Maybe we have a title for our episode. It's one of those things that definitely sounds intriguing in theory. Certainly, if you have the wherewithal to do it, and certainly, obviously, the margin set up to do something like that, it's definitely intriguing. I would love to see, like, again, that proverbial pension fund guy who writes one call a quarter or one call every 6 months, and now you're going to tell him. I'd love to see the look on his face, if nothing else, to kind of explain that to him. But it definitely has a lot of, I think, interest. Let us know if you guys are interested as well as we move on to the big story, certainly of the week from an options perspective. Broke yesterday, actually.
Oh, yeah.
We were doing a bunch of other stuff. And we've talked many times, including a big debate with the Viceroy on our 500th episode spectacular live here in this studio about the endless proliferation of exchanges. That was brought on, of course, by ISE launching their third options exchange, bringing the grand total of options exchanges to 14. And in case you didn't miss it, listeners, yesterday, it seems like the pendulum has swung a bit the other way now, as that exchange that just launched, the 14th options exchange, ISE, the International Securities Exchange, announced it was acquired by Nasdaq. So Nasdaq, as an exchange group which has 3, some may argue 4 options exchanges under its umbrella already. So all slinging the same things you're used to, your Apples, your Spies, your Facebooks, your Googles, etc., doing it on different rebate models. Now just acquired an exchange group that also has 3 pretty much identical exchanges under its wheelhouse as well. So kind of a bit of a head scratcher from an options perspective, but hey, if it's a sign that more exchange is going to become less, I think that's probably a good thing. Uncle Mike, did you have a chance to see this news, and what's your thoughts on this?
I did. And I'm willing to bet at that risk management conference, they never said once, folks, we need a lot more exchanges. I'm guessing that was never brought up, was it?
Especially not because it's done by SIBOs. I don't think they want any more players in there.
That's true. That's right. Forgot about that. So, but yeah, I think it's an exchange buying an exchange. So we're kind of, that's almost like consolidation. I hate to say the word, but yeah, it's nice to go in the other direction for a change.
And I think it's a good thing. You know, any time we can take some exchanges off the board, I think that makes market making easier. That's going to tighten markets. It's going to increase competition. I'm expecting that these will all fold into each other. Mark and I were talking about where the value added is offline earlier, since I'm in studio. And, you know, my guess is that crossing mechanism that ICE has is really valuable. And then, I'm sure they've got some other IP that's of worth to NASDAQ. You know, they've got the PHLX. They don't have an electronic exchange that works exactly like ISE. And maybe this is their way of getting rid of that. You know, how much is it worth to NASDAQ to not have to have the PHLX anymore? Sorry, Philly guys.
That's their end plan. They spent $1 billion to close the Philly. You know, they could have done that for free.
Sorry, Philly guys. Motown Philly's
but they have
gone again.
They have NAM, which is their NASDAQ options market, confusingly named. They have Philly, you know, which is kind of like their legacy platform. They have what effectively is Box Lite. They used to actually regulate Box, and then Box became their own thing. It's very deep in the weed stuff, so they created, but they had that exchange medallion still, so they created kind of a knockoff of Box.
Medallion?
Yeah, or call it what you will. And so they kind of just filled it because those are hard to get. So, and there's some arguments they even had another one in there kind of in the mix, doesn't really do any volume. But still, yeah, they're all, at the end of the day, trading the same things, doing it on different fee structures. That's kind of where the differentiation is. Maker, taker, maker, et cetera, et cetera. Selfishly, for us here at Options Insider, you know, the more the merrier for us. More people out there to potentially compete for our sponsorship, a good thing. But I think this is a great thing because 14 exchanges is just madness.
Well, we're getting close to having the same number of market makers as there are exchanges.
Less.
Makes a big deal.
Let's see, there's Citadel, and then that's pretty much drops off.
You know, I actually got in an argument with a guy at RMC about this. He goes, there are more traders.
You got in an argument with someone? I refuse to believe
I'm not going to say what firm he works for, but he was explaining to me that the reason why things are blah, blah, blah is the regulation. I said, that's the second most important to me. I said, that's the second reason why things are the way they are. And then I laid out exactly what I thought. And then I was like, I started with name 8 market makers. And he got to 7, and then I gave him the 8th.
That's impressive. I don't think I could even do 7 at this point.
Well, he got to 7, then I gave him the 8th. And then I said, now name a couple more. And then the guy was like, well, and I was like, exactly.
Yeah, that's kind of there's definitely a problem when there's more venues to trade on than people actually, or firms, I should say, really trading on them. Really quick, talking about trading too, since we're talking about news of the day. We kind of touched on it a little bit last episode, and it got Andrew's knickers in a twist. So that we need a little more data on it this time. That's difficult. Yeah, that's difficult. That diehard Mainer in him coming out. But this is, it kind of seemed like it was tabled for a while. We discussed this a lot in our advisors option program, but now it's kind of rearing its ugly head again. This Department of Labor kind of fiduciary proposal that effectively will eliminate the use of options in IRAs. It seemed like there was just a huge, overwhelming tsunami of backlash against this back towards the end of 2015, and it seemed like they got the message at the Department of Labor. It seemed like everyone I talked to said it seemed like they were willing to make the changes. Now it seems like with the growing, I think it's going to happen sometime in late March, this proposal is going to go through. And it seems like they're kind of swinging the other way again and kind of leaving it the way it is, which effectively, I mean, Mike, how much of your business alone is slinging options and retirement accounts over there at RCM?
It's a good portion. And so I've looked at it. I'd still be able to survive because I have a lot of clients with multiple accounts. It would just be a giant pain in the butt for me to all of a sudden take the option section of the portfolio and move it into the non-qualified section. And it would be a royal hassle. But I think this is dumb. I've looked at this bill a little bit. And so here's what I think about it. What it's trying to do there's some good things attached to it, and that people want to be they're looking to get transparency with advisors and things like that. Well, to me, I mean, we're very transparent at RCM. You know exactly what you're going to pay. It's very simple. There's no hidden cost. There's no hidden nothing. So with that, I think that should be the way it is with everybody. I coached my son's third grade football team this last fall, and so because of that, I've been involved in football for almost 30 years in one way, shape, or form, as a player, as a coach. But in order to get certified or whatever, I had to get a background check, and then they say, I had to go through a lot of crap when they found out I knew Mark Sebastian, but that's another story.
That's another story, indeed, sir.
Oh, it was crazy. But you had to do something called this Heads Up Football coaching online clinic. And so I'm looking at them thinking, oh boy, they're teaching this wimpy stuff about football, and I was kind of concerned about it, but when I watched it, it was very good in that I thought it was a very proper football proper football techniques. So I'm looking at them thinking the main motive of this is to teach kids to play with their heads up and don't lead with the crown of their helmet. And so I remember thinking about that. I'm thinking the fact that we have to tell kids that is horrible. And if we're that bad, then God bless all this concussion sensationalism that we have. I mean, yes, there needs to be more education and awareness throughout football and the concussions, but here's the Mike Tusaw solution to football concussions. This will eliminate 90% of all concussions in the amateur level. In the NFL, those guys are on their own. I don't see how there's more concussions, quite honestly, but that's another story. Block with your hands, tackle with your shoulders. That will eliminate 90% of concussions if people would actually do that. That's my opinion. Now, getting back to this Department of Labor bill, what has to be done with this is that America, you need to be smarter when choosing an advisor. Choose an advisor who is upfront with their fees so you understand what's going on. And then if you can do that, then we won't need to have these bills that say advisors have to be upfront and honest and can't charge hidden fees. Oh, by the way, we're going to tack on this option thing. So the solution to the problem is that we need to attack it at the source in that, number one, youth football coaches need to get smarter and actually coach it right in the first place. But number two, what we have to do is have it set up to where America, or any other country for that matter, using an advisor, choose your advisors wisely to begin with, and we won't have this problem. Now, the repercussions of this are that there's a lot of high school trainers out there. I'm willing to bet that a kid has a hangnail. Oh, he's concussed. He can't play for 4 weeks. And then because of all the fear going on, high school football numbers are down throughout the country. That's a bad part of it. But the good part is that if this really was a problem and these idiot coaches out there are actually coaching kids to lead with the crown of their helmet, it needs to happen. So there's a bad and a good in concussions, and there's a bad and a good in this too, in that we're going to get some type of regulation, but America, please resist this bill and just get smarter and look better and look for honest people, and we won't have these problems with these lobbyists with an agenda tacking on things that are extremely idiotic, stupid, and awful of trying to ban options in an IRA.
Whoa. Mike, whoa. Mike, are you implying that people should spend more time thinking about their investments and their money than they do shopping for flat screen televisions and for cars. That seems ridiculous to me. That seems outlandish that I should spend more time worrying about the nest egg that I plan on retiring on for the rest of my life than I spend, haggling over $100 on a GMC Acadia. How dare you imply something that is so logical and makes so much sense out of your average American and U.S. government?
Okay, now this is freakishly weird because I was on the phone with a guy looking at a GMC Acadia, ironically, recently.
I told you he's bugging your office. How many times have I told you that, sir?
This is kind of scary, but I'll even take it. Let's take the financial crisis of 2008.
That's amazing.
We're going to even relate it to that. Do you know what caused the financial crisis of 2008? We lied. We as a society lied. Oh, I make $8 an hour at McDonald's. Really? Well, I think I'm just going to accidentally write $28 an hour at McDonald's, and here's your $500,000 home and a NAGAM mortgage. The fact that we accepted all those lies is what eventually caused all this to begin with, and then eventually it trickled up into the big business lies, but that's another story. So what I'm urging people to do, America, come on now. We got to call your congressman, call up your senators. It's an election year. Let's get this thing done, or let's get this thing so it's not passed. And then to solve the problem that's existent, do what Rosa Parks or Martin Luther King did back in the 60s. You want to solve a problem? Let capitalism solve the problem. They're banning minorities, or they're making minorities sit at the back of the bus. Don't go on the bus. Hit them where it hurts. If you want to have an honest financial system, hit them where it hurts. Do some actual homework, and instead of looking at a GMC Acadia, actually do your homework.
Now, to be fair, GMC Acadias are great cars, so that's one that I actually test drove a couple years back when I was deciding between that and my current automobile. But that was just random. That was really random. Yeah, you're right. People need to think. One of the things that constantly, I think Mark and likely Mike and I share this sentiment is how much more time a lot of investment advisors spend learning to sell than they do learning to trade and learning to analyze.
The vast majority of them are pretty much salesmen. The asset management portion of being an asset manager is very much secondary. It's gaining AUM. I mean, you're building a fund now. You see the challenge of gaining AUM. And you can't really fault some of them because if you don't do it, you die. But at the flip side, so many of them who are successful, that's their primary skill.
Yeah, I mean, I consistently run into there's a lot of these guys that I mean this in the most insulting way I can possibly say it. The only people dumber than the investment advisor themselves are their clients. And there's a overwhelming majority of people that fall into that trap. And I'm sorry, folks.
No, he's absolutely right. And, I want to just to add to that, I can remember when I first started out, I don't understand how I did that anymore with trying to trade very, very frequently and still gather AUM. As the years have gone by, just the fact as RCM has grown, I would say a good portion of the assets with which I manage, and my clients know this very well because it's in writing and I've explained this to them very thoroughly, a lot of it has been passed off in terms of having George, Chris, and Tim and our investment policy committee manage a lot of it. Now, there's still some things that I manage, which I talk about on this show. That's never going to stop. I'm going to trade options so long as I have a pulse, but there's no way that I could possibly meet the needs of all of my clients if I didn't have a team backing me up like I do. It's just not going to work. I don't see, even if I wanted to have no life, I couldn't physically do it. So I think that if you look at a lot of things, then there's a lot of investment managers out there. Oh, let's put them in this fund. Okay, good. And it's just a very much a cookie cutter approach. And because of that, now we have to deal with some bill with some senator that probably had some type of axe to grind with the whole options industry to where we can't trade options in an IRA because he's tacking it onto this bill to where if another senator or congressman comes out and says, oh, I don't like that bill. Oh, well, you're trying to side with those evil financial people. And it's just a horrible scenario.
To be fair, it is the Department of Labor, so it's not a senator. But that's where you want to get all your financial regulations, from the Department of Labor. And you're right, talking about unintended consequences. You're right. There is a spirit of doing something right here, which is trying to protect people. But as there always is with a lot of regulatory initiatives, the devil is in the details, and the unintended consequences here are pretty stark. I mean, it's pretty much, it looked like at the onset when this debate really started unfolding towards Q3 into Q4 of last year, it looked like that it's kind of was a sin of omission. They were just leaving options out of the definition of what could be defined under this fiduciary exemption. They had every other asset under the sun except for, I mean, they even had annuities in there, for God's sake, except for, which incorporate derivatives, a lot of them, which is ironic. But nothing there for any sort of listed options product. And it seemed like they were going to just add it in. And now here we are in March, about 5-6 months later, and it seems like they're not going to head that way. So listeners, I'm sure you guys have some thoughts on this. Let us know what you think as we keep on rolling into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Everybody, that funky tune. It means it's time once again for the Odd Block, the portion of the show where Mark sweats profusely and I run down a number of the interesting and or unusual options trades that caught our attention today. Going to kick things off in some of the, I think, more esoteric realms of the market. A lot of times we've been talking a lot about energy lately and mining and things that are very much related to what's been going on in the space. And we'll get to, I think, one of those in a little bit, but we're going to kick things off in the realm of Club Corp Holdings Inc., ticker symbol MYCC, My Club Corp. Closing today right around 14.5, up about 20 cents or a little over about 1.5%. This is the name that does a whopping 237 contracts a day, doing over 7,000 today, approximately 7,500, and pretty much the lion's share of that coming in just to mark a call palooza out here in June. It was started off catching our eye was paper gobbling up the June 14s and the 15s, doing that 2,500 times each for $1.75 and $1.10. Looks like as the day went on, about 1,600 of the 13s went up as well. I have to assume paper buying. I haven't had a chance to dig into the paper on that strike as well. All of this opening paper, no open interest really to speak of at all in any of these strikes. Obviously, the name does 200 some odd contracts a day. It's not really lighting it up from a volume perspective. But yeah, this looks like this is pretty much, as it appears to be on the surface, Mark, a mega stupid going up out here in June. I can see through the magic of Skype. Tusaw's ears are twitching. Does this intrigue you, Uncle Mike, the size of this mega stupid here in My Club Corp Holdings?
There's no stupid that's not a good trade.
Yeah, of the June 14, like you said, the June 14, 15 stupid, but you also had a bunch of buyers underneath. It looks like the market makers then went after the 13s. So kind of volume across the board, where they sold the 14s and 15s, and then underneath the 13s traded in size 2. So you had those two trade 2,600 times, and then you had another 1,600 go up on the 13. So looks like Club Corp Holdings seeing some bullish action.
Some put love, or excuse me, some call love up here. And you're right, I was digging into those 13s as we were talking. My initial blush was like yours. It was market makers saying, we got to hedge this somewhere. What can we get? But it seems like a lot of that was paper buying too. So it could be a bit of some split activity on that strike. But still, yeah, just a call frenzy across the board. So here we are, like stupids here on the show. Some more than others. And stupids rearing their ugly head yet again here on the old program. It feels like a three-leg stupid this time if all that paper is to be believed. So interesting stuff afoot. Let us know why, or perhaps you guys already have written in on the great stupid debate, so we won't have to beat that again. But if a lot of you guys have some questions about that stuff, then I will make sure to relay it to our stupid expert, a.k.a. Uncle Mike, as we move on to our next name. This gets more into the mining realm. This is Peabody Energy Corp, ticker symbol BTU, ironically. Closing today, $6.40, up about 50 cents, or about 8.5%. This is the name that's kind of been rocking and rolling of late, doing about 19,000 contracts a day on average, doing nearly 134,000 contracts today, really lighting it up. And surprisingly, despite the upside rally out here today and all the volume going up, what caught our eye was actually on the put side. In particular, it was the regular April, not out there in the weeklies, the April 3 puts going up. Paper, it looks like paper buying these suckers for, about $1.10 or so, going up for a total of, let's see, the size here is a little bit wacky because it actually wasn't the regular April 3s, it was the weeklies going out on the 22nd where the paper really got the lion's share of the ball rolling, picking up, starting with about nearly 10,000, paper buying for $1.10, and as the day went on, pretty much 2x that, over to about 20,000 going up total on this strike, the latter kind going up at some different prices as you might imagine. We've seen a bunch of different ways that these trades are going up. It's first size chunks and then smaller a little bit later on. So a bit of an interesting one. No open interest to speak of out here. I did see some people writing in after we posted this and saying, hey, it looks like there's some rumors that this name may actually be facing bankruptcy as well. So that could be perhaps behind some of the spec and perhaps the rally today, a bit of squeezing out the shorts before that bankruptcy happens. Either way, Mr. Greasy Meatball, what you take here on this options palooza and indeed a put palooza out here in BTU?
I mean, coal is so popular with the current administration. I can't believe that anybody would want puts in this name. And I would say that was an incorrect use of the word ironic in BTU. I would say that it's actually, it's the appropriate symbol, BTU. But no, I think you're right. I think it's just it's hedging activity, it's trading activity of traders that are looking to stave off. Now that it's gotten a nice little pop back, stave off getting pounded.
Yeah, it is ironic when you see the rumors of bankruptcy swirling and the name rallying. Something is afoot out there. Probably a bit of the shorters getting squeezed before perhaps the death knell. But they're saying this has quite a bit of debt in this company, $6.3 billion. In debt for this name. So we know a lot of other coal companies haven't fared too well. This one perhaps could be following suit. We'll keep an eye on that one. See if our friend here loading up on these puts here in April is on the right track. As we move on, we're kind of all over the place from a sector perspective today. Going to finish up in the realm of nice quality hoteling, in particular Hilton Worldwide Holdings, ticker symbol, good old Hilty, HLT, closing today $20.51, off about a quarter, about a little over 1% on the day. This is the name that does, let's say about 5,000 contracts a day, doing nearly 30,000 today. So really lighting it up here in the old option space. And what caught our eye was a bit of an interesting three-way, not the Paris Hilton variety, but the options variety, going up. Puts over a call spread. Started off going up 10,000 by 5,000. Looks like paper doing the April 20 puts over the April 21-22 call spreads, doing the puts for 65 cents, the call spread, the vertical, for about 30 cents. As the day went on, a little bit more volume piling in, total of 12,000 on the puts, same number on the calls, only 5,000 on the vertical, going up in 3 blocks over there on the CBOE. Looks like paper selling that put and then using that to finance the old vertical. Doing it on a bit of a ratio, obviously, about 2-to-1 or so on the puts over the calls. Interesting trade. No open interest to speak of, really, on either of these strikes, so there is some size open on the April 20 calls. An interesting play here for good old Hilty. We love ourselves a nice bullish risk reversal on the show here. Mr. Greasy Meatball, what's your take on this one going up for some size here in Hilton?
I think you hit the nail on the head. I agree with you wholeheartedly.
As you often do, sir.
Indeed. That's what I'm known for, is agreeing with Mark.
You're like the Ed McMahon here to my Johnny Carson. You are correct, sir. All right. And with Mark agreeing profusely, we're going to keep on rolling right on into it. It's Thursday. It means it's time for the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for The Mail Block.
This is the Mail Block. This is the portion of the show where we answer your questions. You guys can also get at us live if you like. We've got a few more minutes here in the show. You can probably the easiest way to do it on the Mixler chat room, but a lot of you also like to hit us up. Twitter, Facebook, etc. We'll try to monitor those as the show winds down here. Meanwhile, we've got a follow-up question coming in. This was actually, I believe from last week when I was traveling, so I didn't have a chance to discuss this debate here. But this is from Alex, who was written in before about longer-term versus shorter-term puts. I believe he was selling about a year-out puts in LinkedIn. We had a nice back and forth about selling long-term versus selling shorter-term premium and the pros and cons therein. I think you guys debated it a little bit more, Mike and Andrew, last week here on the show, where he's got a follow-up. He says, in Option Block 503, we agreed, I guess we collectively on the panel here agreed, that while it's very unusual, the 25-day 25 delta, he wrote it a little weird here, 1 year cash secured put was entered for all the right reasons. The follow-up question then is, what are the various practical ways to risk manage / babysit a long-term cash secured put under different scenarios of the underlying, trending up, trending down, or sideways, or for different regimes of volatility? Cheers, Alex. Mark, this kind of gets back to what you and I were talking about. Ironically, we had a lot of very prescient conversations before the show. We were talking about the use case and the efficacy of, in that case, we were talking about buying 2-year outputs and how maybe some of the mitigated value of that as a hedge. Alex now asking kind of the flip side of that coin. If you decide to write 1-year outputs, what can you do? This is one of the reasons, quite frankly, that I'm not a huge fan of this strategy, and probably I'd imagine you aren't either, is because you are kind of limited in your options, pun intended. Once you put it on in that 1-year period, first off, the spreads are going to be wider, so you're paying a decent amount to get into that trade. So you can't be taking it on and off like you trade in front month at the money Apple all day long, adjusting it all day. So your adjustments, let's assume that off the bat, your adjustments are going to be limited with this trade to begin with. So you have to wait for some decent movement. So that's probably one of the first negatives that I don't like. And then, of course, once you start getting into some of the other scenarios, I mean, you're not getting the gamma you might want in a trade like this. Vol is a nice exposure, but I don't think actually you had a chance to weigh in on the earlier portion of this. Again, it was a debate between selling 1 year versus 1 month LinkedIn puts, but it applies to everywhere. What are your thoughts just in general on long-term versus short-term premium? Then we can get selling, and then we can get into some of the babysitting elements.
Long versus short-term premium selling. I mean, I certainly am a more proponent of nearer-term premium selling than longer term. I mean, there's a reason why calendars over time make money as opposed to lose money. If you sell something near term and buy something long term, it generally ends up being a winner. And, it really depends where you set up the trade. Now, one thing about a 25 delta put is that's kind of starting to get toward the range where the 1 month put is actually maybe not gonna lose money as fast as the 2 month put. So one of the common misconceptions about decay is that we all know that beautiful chart of decay getting exponentially higher and higher.
It's a lovely chart. I have it on my wall.
Yes, but people forget that applies directly to at the money, not out of the money options. So as you move closer and closer to kind of the 10-15 delta range, you really want to be short puts at the, not you, but from a decay capture standpoint, statistically, there's more raw dollars to be captured in the 70 to 30 day period on those type of options than there really is from the 30 on in. And so it's not a simple answer. And so my answer would be, maybe not 1 year, but I think that rather than 1 month, I'd be certainly at the 25 delta, I'd be looking more at the 2 to call it 45 to 75 day period.
Yeah, you're right. In that 25 delta range, he is getting in that a little bit different because all these, we've talked about it before on the show, all of these scenarios are talking about with the near exponential decay. You're right. That is the at the money. That's where the decay is the sweetest. The juice is the sweetest there on the at the money. Once you get into the 25 delta, you get into a little bit different scenario on there. We could probably spend a whole show outlining all of these different scenarios he wants. Trending up, underlying, down, and sideways. Uncle Mike, what do you have for these different scenarios here for our friend Alex, who wants a whole hour's worth of education packed into a few minutes here?
Alex, first off, thank you for all the questions that you've been asking about. It definitely has made for some good show. Made the show a little bit better because of this. But I think it needs to just continue to be very simple. Let's say that XYZ stock is at 60 and you're selling the 50 put a year out. I think that what you need to do is, and let's say you get $5 for it. I think that when you get out of it, you have your line in the sand as to as soon as this put becomes worth $7 or $8 or whatever you decide, that's when you get out of it. And as soon as the put becomes worth $2 or $1 or whatever your line in the sand is, that's when you get out of it. And you only do it once because, excuse me, by taking on a longer term position as such, you're looking for either movement in the underlying or you're looking for it to really sit still for a long period of time. And from what I remember from some of your previous questions your previous writings is that your belief is that volatility is high and it's going to come down. And by selling a longer term option that far out, you're essentially trying to be bearish on the longer term volatility. And if that's the case, and you're trying to have that as a play more so than the theta, and if that's the case, and I'm just trying to go from memory of what your questions were, if that's the case, then I think you need to have a line in the sand as to when this option, I sold it for $5 as soon as it goes down to $2 based on all of my formulas and all of what I'm looking at, that's when I've gotten volatility to come down to where it needs to be. So I think it needs to be simple, Alex. Have a way out, have a way, whether it's good or whether it's bad.
Decreasing Meatball unfortunately has to leave us. I'll let you do your plug. A little bit early, sir. What's going on in the land of the pit, sir?
You know what? Read our blog every day, optionpit.com/blogs. Yesterday we were talking about the rally in VVIX and continues to happen. So every day we're going to try and put something out there that's valuable to especially this audience. So, Mark, thanks for letting me park here. It was good to hang out for a while. And Mike, good to hear your voice. Hopefully I'll be in here more often. That's my plan.
Well, as the studio keeps expanding and evolving, we'll be certain to have more in-person guests. We'll even get Uncle Mike down here once or twice more here as we work it out. Even though I know you're planning to do your show on a boat, Uncle Mike here. But yeah, great questions here. Actually, I'm looking at his scenarios, trending up, trending down, or sideways. None of those are really that bad for his short put position. He doesn't mention the one that's really the killer, which is of course the sharp gap to the downside, which is where any of these scenarios, they sound like they're he'll have time to roll and adjust if he needs to. So I'm not too worried about Mr. Alex in these scenarios. I think we've got time here for one more quick one here before we close out the old show. Let's go to, this one comes from 777. He wants to know, are there any differences trading options on regular ETFs versus options on levered ETFs? Any quirks to trading the latter versus the former? I think the biggest quirk, they kind of ironed out about a few years back or so. Remember in the early days of trading options on levered ETFs, Mike, it was kind of the Wild West. People discovered very quickly that they can kind of swing for the fences and get kind of an extra bit. They're trading a levered instrument on an already levered instrument, and so it was kind of like swinging for the fences, and it was kind of crazy town. And then a couple of years back, the brokers also collectively realized that, and they all kind of clamped down on the margin. So the margin's going to be a lot tighter on some of these products than maybe you might expect. So you're going to have a little bit less free capital in your account if you are going to be slinging and shorten premium, et cetera, on some of these levered options. That's probably the biggest quirk. Aside from that, Mike, I would think, to me at least, whenever any of these levered products, to me, the devil is always in the details. And I'm not a huge fan in general of the entire levered ETF segment for the simple fact that most of them are constructed very poorly and don't really deliver what they intend to do. If you have one that you think delivers well and it has a deep liquid options base, that's another big caveat. You have to have liquidity out there. Then you should be fine trading options on it. But good luck finding that. I don't know, Uncle Mike, are there any levered ETFs out there that you're comfortable slinging a lot of options on?
No, I think that levered ETFs were a great solution from a place where there was no problem. That's my opinion on it. If you want leverage, you can trade options. You can set up a trade to get as much leverage as you possibly want. I don't see any inherent advantage to trading options on an ETF, on a levered ETF. I don't see any advantage to buying an ETF. Why don't you just buy a stock on margin? You're going to say, oh, well, Mike, why don't you just buy a levered ETF? But what if you want to do it in an IRA? You can't use margin in an IRA. Well, buy an option in the IRA. Oh, wait, the Department of Labor won't let me do that anymore. So maybe they'll allow levered ETFs in an IRA. Who knows? But no, I stay away from those things. If you want leverage, if you're smart enough to trade options, you should be smart enough to see how you can create an option trade to where you don't need a levered ETF. That's my opinion on it. Unless you have something like the boys over at Option Pit do, to where if you want to go, they have a strategy on VXX to where they're kind of gaming the system, so to speak. If you have something like that, then by all means do it. But in general, just trade options.
Yeah, I've often jokingly, maybe only have jokingly referred to levered ETFs as kind of the poor man's option. That's kind of a role they played for a long time. If you were afraid of or scared of or didn't want to have trade options, but you wanted to have a similar, or at least an ostensibly similar return, then levered ETFs could be the way to go. But yeah, I'm much more of a fan. Obviously, I'm in the options camp, and much more of a fan of doing it yourself, rolling your own with the options yourselves, rather than relying on some ETF provider to do it for you. All right, that's all the time we got for questions. Let's keep on rolling into our final segment, Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block. Like we said, we talked a little bit jokingly about Dollar General at the top of the show, but they have been lighting it up today. Aside from that, not a heck of a lot of earnings are really on the horizon. Seems like eyeballs are being turned back into the realm of the macro, and indeed the commodities. Oil certainly back on the headlines there again, as well as we're getting into that electoral season. So who knows, maybe a smattering of that electoral volatility will soon be making its way into the marketplace, particularly now that we're getting somewhat closer to finalizing the two candidates. That said, Uncle Mike, what's catching your eye for the rest of this week into the old weekend?
I wish I still had them, but from back in the year 2000, they wear those New Year's Eve glasses where it shows the year. I wish I still had my 2000 glasses, because that's basically what I'm looking at on the S&P. I like to be a bull long term, but I think 2000's a tough hurdle to get over as of now. Or at least that's what it's shown recently. But I would really like to see us breaking that 2000 mark on the SPX and actually staying over it for a little while, because of the fact that we seem to be magnetized to the downside on 2000.
Magnetized to the downside, I like that. But you are the diehard bull. In the meantime, you're not going to be, maybe rolling some puts to the downside or anything like that, just to line up anything in case we dip. Or you're just kind of playing the wait and see.
I've been putting a few long delta plays on recently, but nothing of any major significance. Just trying to have a little bit of bullish exposure on, but my rules dictate to when we're down on the year, I can't go all in.
Got to follow those rules, baby. And our rules say that when it comes to this portion of the program, this is pretty much when we start to wind things down. But before we do that, as always, let's check back in one last time with my cohorts, my partners in crime, on the old Option Block All-Star panel. You already heard from the Greasy Meatball. Surf on over to the realm of OptionPit.com. Check out their classes, their coursework, their archived webinars, and all the other fun stuff that they're doing over there. If you want to get some education in the realm of options or some mentoring, check out what the Greasy Meatball and the Rock Lobster have to offer you over there. And now we turn our attention once more to that sleepy hamlet known as St. Charles. Uncle Mike, what do you have cooking up for our listeners, sir?
Once again, I want to remind everybody, it is IRA season. If you have not made your 2015 contributions yet and you're curious as to what you can put in, how you can put it in, and what would be the best way to do it, give me a call or send me an email. I'd be happy to work with you along those lines if you want to talk with someone who does that type of thing and also understands options. 312-212-3531, or send me an email at mtosaw@rcmfs.com.
And of course, I want to thank everybody out there for downloading and streaming and subscribing to the show after the fact. And of course, for all of you out there streaming it live as well. I love to see the streaming growing as the episode keeps going on. It's always fun. If you want to ask questions, the chat room, probably the easiest place to do that, but you do have to make a Mixlr account. So if you're not comfortable with that for whatever reason, hit us up via the old-fashioned ways. The easiest way probably to hit us up, the social media, Twitter, Facebook. We'll be monitoring that throughout the show. Email, probably won't get that till afterwards. So if you want to get it answered on the show, use those primary outlets and we'll have a chance to chat with you, which we love to do. And on behalf of Uncle Mike and, of course, the Greasy Meatball and indeed myself, I want to thank all of you out there in the listening audience for indeed all the fun stuff you do and streaming live and, of course, sending in such great questions. Keep them coming. And we'll see you next time right here on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.